Welcome back to the crypto simulation. Today I'm going to talk about risk management, part 3, understanding market psychology. This is part of a 5-part series on risk management to help you better navigate the markets. Nothing in here is financial advice, and I'm not your financial advisor. So the risk management series consists of, like I said, 5 parts. You have part 1, the investor mindset, and part 2, portfolio optimization strategies. This is part 3, understanding market psychology. And then we have using risk metrics and profit taking and market exit strategies. Social links are over here in the description. Follow me on my free Telegram, the Snake Pit, to get exclusive free access to my portfolio management tool, which is available to you for a limited time this month in March. So I want to talk to you about the different aspects of market psychology that will help you to become a better trader. And it will help you with more than just your trading. But let's start with the first thing, which is herd mentality. So community is at the core of crypto, but it can also be dangerous. Buying and selling occur in social movements and can lead to feelings of FOMO and fear. YouTube influencers, crypto, Twitter, or X, and other social media outlets subconsciously influence our investment decisions. Fear and greed is something to be aware of because the market oscillates back and forth depending on the fear and greed. I took this snapshot today. Looks like we're still at some pretty high levels, and we can stay at high levels for quite a while until we get way too greedy. Like I think we're like around 82 on the greed scale, 50 is neutral. And when we get way too greedy, generally we have to have some cool-offs. But the switch from fear to greed tends to be very slow and take place over a long period of time before it switches to the other trend. Another thing to be aware of is market cycles and sentiment phases. And this is the Wall Street cheat sheet, which kind of goes through the different aspects that you face during a market cycle. So you start out with a disbelief rally like, oh, this is going to fail. We're never going to come back. And then you have hope. Oh, a recovery is possible. Goes sideways for a little while. Optimism. The rally is real. Belief. Time to get fully invested. I feel like right now in our Bitcoin cycle, as of this recording, which is March 13th, we're somewhere in between optimism. I think we're just kind of getting into optimism, maybe belief, somewhere in there. Then there's thrill, euphoria. I'm a genius. We're all going to be rich. Now, when everybody's a genius, that's usually when people start selling in a big way. Oh, complacency. We just need to cool off for the next rally. This happened in January of 2022 after the 2021 top in November. Anxiety. Why am I getting margin calls? The dip's taking longer than expected. Denial. My investments are with great companies. They'll come back. Panic. This is going to zero. Capitulation. Everybody's getting out of the markets. Anger. And finally, just this downward trend into depression. And then from there, the market trends back up again. So it gives you maximum greed to maximum fear. And you can see here, peak point of maximum financial risk is at euphoria. And then through the point of maximum financial opportunity in the contraction phase, and then back to recovery and prosperity again. So everyone feels like a genius at some point during a bull market. Getting cocky from a few lucky picks can lead to recklessness and carelessness that leads to poor investment decisions, wiping out all your gains. Anchoring is the practice of holding cryptos through bear markets, believing that they'll return to their previous all-time highs. And this is often known as the anchor price. This is pretty unlikely to happen, though, for most crypto projects. A lot of them won't return to their previous cycle all-time highs. Bitcoin and Ethereum have a much better chance of doing that, but outside of those two, there's not very many that will be able to meet or exceed their previous all-time highs. Recency bias. So if the markets have been going in a particular direction for a while, like let's say that they've been bullish for a really long time or bearish for a really long time, it's natural just to think that this is how it's always going to be. But this is recency bias. So when in doubt, zoom out and you'll see the markets are shifting direction quite a bit, or just look on smaller time frames and you can extrapolate those out to larger ones. Loss aversion. People sell their profits. Look, taking profits is not a bad thing, but some people sell way too soon because they're scared of losing money and they miss out on major gains because of that. And that's because negative feelings such as losing things, we feel like 10 times stronger than winning feelings, than when we gain financial freedom or when we make profits. We don't feel that for as long and as with such endurance as we do financial losses. confirmation and hindsight bias. Hindsight bias happens when you look past your market performance. You look at past market performance is obvious. Like, oh yeah, I should have bought there, or I should have sold there. I wish I would have bought more. That is hindsight bias. Or maybe you feel like you're doomed to keep repeating the mistakes of the past because you keep looking at the past charts and, oh, how did I not notice that? Yes, everything's obvious in hindsight, but go look at the chart right now and tell me exactly what's going to happen 3 months from now. You can't. Confirmation bias is something we all do, and this is where you look for patterns in the market or patterns in the chart that fit your overall thesis, your preconceived notions or narratives, and you actually start to make patterns in the charts. This is similar to what we do on a Rorschach exam, where you look at a random ink blot and make something out of it when there's really nothing there but ink on the paper. So that's something to watch out for as well. And then there's just some other general market psychology things to be aware of. Buy the rumor, sell the news. This happened recently with a project I was invested in where there was all this hype leading up to the release of a product. But once the product was released, we went from being up like 7x to just crashing hard. And that's common in crypto. The market functions off hype, FOMO, the fear of missing out. I generally don't recommend chasing rallies, but you'll see something going green and everyone's going towards it. I call this the madness of crowds. But it's by the time you've heard about something and it's been all hyped up, it's probably too late to get into that project to make the kind of gains that you could make elsewhere. FUD, fear, uncertainty, and doubt. So you'll see people try to FUD promising projects. You'll see projects that haven't really moved much in terms of price. Like this has happened with Polygon, and there's like so many people just saying, oh, Polygon's dead and all this and that. I personally like those kind of projects. Like, yeah, FUD it all you want. I'm going to be right there because one day you're going to be having FOMO when I'm making those gains. Pump and dump schemes. So you have like really clever marketing scheme to try to get you into a project that's worthless, and then the whales dump on you. Speaking of that, whale manipulation. People who hold very large shares of a crypto project or like a stock in traditional markets have the power to move the markets in really big ways, although more so in the crypto markets because the crypto markets are unregulated and they can kind of move the markets to fit their narrative. Technical analysis triggers. So these can be things in the market that are almost like a self-fulfilling prophecy that you see play out with TA, a little bit like confirmation bias. Smart versus dumb money is this belief that smart money buys the lows and dumb money buys the highs. Really, there's no such thing as smart and dumb money. It's just a market cycle. Contrarian investing, this can work out sometimes, but if you get too attached to it, this is the belief that the masses are generally wrong, the news is wrong, whatever Jim Cramer's saying is wrong, and so on and so forth. And being a contrarian is just going against that, and you think, I'm just going to go against whatever the popular narrative is, and I'm probably going to be right. Yeah, you'll be right probably more often than you're wrong, but you'll be wrong sometimes. Sometimes the popular narrative is exactly what plays out. And then shilling is the practice of trying to sell people on something that you're investing in to better your own bags. The role of hype. So hype is really what drives the market cycle. It's unavoidable. You're going to fall for it, and if you don't, you probably you're probably not in this market. You're not going to make it in this market if you don't buy into hype. We all have to buy into hype. So hype increases the visibility and perceived value of a digital asset by drawing in new investors like you, inflating the price beyond fundamental valuations. This is a bull market. This is essentially what a bull market is. You got social media, influencers, KOL endorsements, same thing, viral marketing, and the bandwagon effect because everybody wants to be part of something special. And this can fuel that belief that this is a once in a lifetime, never to be seen again, lifetime opportunity. And that is going to drive price up, but the crypto game is knowing when to sell, right? It's a game of chicken. You got to know when to sell. These bullish movements that go straight up, they're not sustainable. They lead to price bubbles, overvaluations, and then a very sharp correction once reality sets in and people start taking profits, hopping the bubble. So some personal reflections that I drafted about market psychology in kind of a more narrative kind of way than what I've just gone through. What I drafted before was kind of a little bit more just general bullet points. This is kind of a brief reflection on market psychology that I wanted to share with you that I wrote 2 nights ago in my Telegram group. So, your crypto investment thesis is a direct reflection of your underlying psychology. Self-awareness is necessary to mindfully connect the two, and once you have done that, you'll be rock solid in your core, and nothing can scare you out of your holdings because you have deep, sound reasons for what you hold, why you hold it, and why you're in this space to begin with. You're a powerful force to be reckoned with once you've reached this level of enlightenment and are quite likely to make significant profits, not just financially, but physically, mentally, and spiritually as well. Never get comfortable and complacent in crypto, or let some influencer make up your mind for you using the tactics of cognitive dissonance, sleazy marketing funnels, or making you doubt yourself. Crypto is a brutal game, and the influencers are out to take your hard-earned money away from you to better their own positions under the disguise of offering you some stupid course or product that only serves to line their pockets. If you're going to subscribe to anything or anyone, make sure that you are getting value from it, be it risk metrics, indicators, or perspective, and this is whether you're paying for it or not. Ask yourself, is this person helping me increase my self-confidence, or are they eroding it away and making me second-guess myself so I'll simply do what they say and become one of their automatons? This is especially prevalent with narcissistic influencers who think that their way is the only way, and if you do it any other way, they're going to make you feel dumb about it, and it does affect your decisions. Obviously, I've been there and been in that position as someone who succumbed to the subconscious will of another influencer. We are all victims of hypnosis, and we can be hypnotized. That's what happens. It's so easy to happen to us. The name influencer, says exactly what they are. They're hiding in plain sight, influencing the market, influencing your behaviors. You need to influence your own behavior. Now, impossible, right? You're going to be influenced by people, but you need to have that self-awareness. It's not just the YouTubers you have to worry about. It's the glitz and glam, free airdrop marketing blitzes with shiny bells and whistles that use advanced psychological techniques that are proven to take money out of your pockets and enrich the pockets of venture capitalist investors who got into the project at a tiny fraction of what you entered at. And they'll be the first to dump hard on you unexpectedly and take your profits. Again, crypto's a game of chicken, but the venture capitalist projects that have all those VCs and huge amounts with the token holders, they got in at prices that, they're probably like 1,000 to 10,000x up compared to you. You need to ask yourself, am I buying this project because of its shiny bright colors and graphics? Might not be a bad reason in a bull market. Pumpamentals are a real thing. I'm hearing about it everywhere and it makes me feel good. Or is there something real under the hood, something beautiful but hidden? Now, I know in past market cycles it's really hard to find that because most altcoin projects just weren't anything special. But now we actually have altcoin projects that have real world utility, that are developing actual products. So go check out what's in this space. You'd be surprised to see how many cool things there are. Now, this doesn't mean you shouldn't invest in worthless garbage. We know worthless garbage pumps in bull markets. And so pumpamentals and shiny marketing can work until it doesn't. So know when to get in and get out. But in general, I don't like to buy those kind of projects. Maybe it limits my gains, but I just don't like it personally. Guarantee you that these larger crypto projects hire psychologists and marketing experts to figure out the best way to sell you complete garbage packaged as gold. The biggest influencers for you, however, are your own thoughts, beliefs, and biases. Negative thinking will get you wrecked, especially if you feel that you are doomed to always buy tops and sell bottoms. The way you speak to yourself, your internal monologue, matters a lot and heavily influences your investment decisions. Magical and delusional beliefs, addictive tendencies, and impulse control issues can be quite problematic and lead to poor financial decisions. There's no safeguards in this space against that, and plenty of people will be more than happy to take advantage of you. Crypto is simultaneously a game against others as it is a game against yourself. Invest as much in yourself outside of this space, prioritize your mental health and well-being, take breaks from checking prices obsessively, and do things you love to do. If you need to, set alerts on TradingView for important price points so you don't have to keep checking prices every single second. Ask yourself, are you overinvested? Especially if you're having feelings of desperation and financial despair. If you're thinking of selling your house for crypto, selling your car for crypto. And look, all of us have probably been there at one point or another where we felt that desperation. It might even be what got us into the space in the first place. But if that's what's happening, then you have a problem. Don't let yourself make a financial decision that you will regret later. Hey, it could work out, but the risk of doing that is what? Being out of a home and all your savings? Not worth it to me. You are the creator and reactor to the evolving conditions of the game. In this introspective challenge, every move requires you to predict and respond to your own tactics, mirroring the crypto market's self-reflective nature, where investors often react to their own collective behaviors. You must confront your nature and the consequences of your free will, facing the outcomes of your investment decisions. Playing a game against yourself demands an understanding that your opponent is a mirror of your actions, biases, and decisions, requiring a deep understanding of yourself and the system in which you operate. So in summary, market psychology is heavily influenced by emotions, including fear, greed, and herd behavior, which can lead to irrational trading decisions. And this does not mean that trading should not be emotional. All trading is emotional. Even if you have a plan, the plan came about through emotions. So we need to have an awareness of what those emotions are and learn how to manage them. We should not learn to we should not try to bury these emotions and not feel them and act like a computer or robot, because if we do that, well, odds are we actually are going to give in more to our emotions than if we just kind of roll with them and be aware of them. That's been proven in psychology. Understanding the psychological phases of market cycles can lead to better timing and entry and exit positions. So watching this video over and over again and really digesting it will probably help you do better in the market in some ways than looking at a bunch of risk metrics. Now, you need both to do successful, but if your psychology isn't down, if you don't understand what makes somebody a great chess player, right? Yes, there are, we can memorize hundreds of thousands of moves. What about a poker? Yeah, we can memorize hundreds of thousands of different variations that we can play. And that part is important, but what's more important is knowing how to read your opponent and knowing how to read yourself. Recognizing and mitigating your psychological biases in trading, we all have them, is crucial for effective risk management. Hindsight bias, confirmation bias, cognitive dissonance, which is a form of bias. That is important for you to navigate. Okay, well, I hope you enjoyed this brief but informative video. Definitely bookmark it, share it with all the people that you care about, who you want to do better in this market cycle. And there's advice in here that I think extends beyond crypto, and we often forget the importance of psychology, both individual investing psychology, which I covered in part 1, the investor mindset, and market psychology, which I covered in this part. Those are important. They're very important parts of your investment profile. You have to have the half psychology, half technicals. So in part 4, we're going to talk about the risk metrics that I use to navigate the market and maybe give you some ideas for how to use those risk metrics. And this will dovetail nicely into part 5, which is about profit taking and market exit strategies, which are one of the hardest things to do in a bull market. So thank you for watching. Don't forget to like, subscribe, and comment to my channel. My channel is very new. I've only been doing this for about a month. We've been growing really fast, but every subscription matters, and I will push out high quality content to you like what you've seen tonight. Also, I have a really, really great Telegram group that's also been growing quickly, although we're still fairly small at just under 200 members, the Snake Pit. Be sure to join that. And if you do join that, this month, I'm going to give you a portfolio management tool that I created for myself last year and I use to help me navigate this market. I'm going to give that to you so you can navigate the market better. But you have to join my Telegram group so I can give that to you, and it will be periodically given through the alerts channel, or just ask about it and someone will throw it your way. So that's it for tonight. This was a really fun video to do. I love psychology, and I especially love market psychology. And you want to study market psychology just as much as you study the charts to do well. Again, nothing in this video was intended to be professional advice. This is not, YouTube is not therapy, and I am not a financial advisor, so nothing in here was financial advice either. All this is for purely educational entertainment purposes only. We'll see you next time in the crypto simulation.